So here we are on the EU again on the daily time frame. Yesterday, Thursday, took out Wednesday's low and closed strongly back into the range, all after tapping into this daily fair value gap. Therefore we might expect bullish prices, and also it was tapping into this order block. And the other reason to look for bullish trades is price has been going down the whole week. So therefore thinking thank God Friday is not a bad idea, I guess. So therefore my bias for today was bullish. So let's take a look on the 50-minute. What we have, obviously here we have Thursday that took out Wednesday's low. That has created this bigger dealing range where price is currently in. So this is at this moment the dealing range. This is the start of the Asian session of Friday, and this is London. So when London was starting at this point right here, it was sitting below the 50%, meaning we are in a discount of the overall range. And if you move, so that's also a reason to look for longs. And if we measure this move to this high right there, that's a dealing range. Why? Because it took out obviously these lows, but this high took out this relative equal highs right there. So therefore making this a valid dealing range. So price trades back exactly to the 25% level when London opens. What is in alignment here is this fair value gap that's resting right here. And this fair value gap also takes out this high right there. And also there is this fair value gap right here, which makes this portion where price trades into a balanced price range, which also should support higher prices in this case. So price trades lower, look at the bodies, respecting the 25% area, tapping into the fair value gap, and then price should go higher. So let's see on the lower time frames if you can find an entry there. So I'm using in this case the 2022 model, which states that we need to take sell side first, which happens right there. Here's the sell side taken right there. And after that, it needs to take buy side with speed and leaving a fair value gap. So we're finding the swing high. There's this one, there's this swing high. So based on the 5 minutes, we want this swing high to get taken out with speed. And we did not so in the first half of London. We did with this big bullish candle. So then we have this low to this high, taking out this high with speed. And then you are looking in this lag for fair value gaps. Is there one? Yeah, there is one resting right there. And let's see. Not the only one. There's a very tiny fair value gap resting right here. And there is a fair value gap right there. But this fair value gap has already been traded into. And really the move started from this low, from this swing low to this swing high. So that's my range where I'm looking for fair value gaps. So I find one right there. And as you can see, price came back, traded into it, body staying inside a fair value gap, wicks to the damage. The wicks is retesting some other highs right there. And you could have placed an entry right there, for example, stop below the swing low, which was in here, or you could take this swing low or this swing low, maybe something like this. Targets, you find targets on the high time frames. Well, we're entering here. So what do we have above we do have these relative equal highs resting right here, so that's where it is already right here. And of course, there's this swing high right there, so you could aim for that. And there is also a weekly opening, which is also a strong resistance. And another thing you could do is to drag out this one and aim for this consequent encroachment to target that high. In hindsight, it's all easy. In hindsight, we can see all targets met. I think personally, I would have targeted these equal highs when using the 5-minute time frame at least, because we can also go lower to the 3-minute, for example. Where is it? Oh, I didn't. Oh, this. To the 3-minute, which high got traded through with speed. These lows are taken. Here, this high was now taken. Was there speed? Yes, there was speed. And there was a fair value gap right here on the 3-minute. So it's also respected, and then you have a better entry, because then you could enter based on this candle, low stop loss below this low, and then you could even target this for a nice trade. That would be a very, very nice trade. Now you're trading the market maker buy model in here. That would be very nice. So that would be the 3-minute. Let's see in the 2-minute. What we need is speed, breaking a high, a swing high. So here the liquidity is taken. So from this point forwards, we are looking for a high that gets taken with speed. It's not really taken already. That would be this fair value gap, because here this is bigger range that we also saw in the 5-minute from this low to this high. This is taking out highs with speed. Then price trades back. We could use this fair value gap right here. Right there, something like this. Why do I pick this fair value gap? And how would I trade it? Well, this is the accumulation phase, and this is the candle that displaces out of this consolidation, then trades back to it, and this is the real move that takes out this high right there. These are the highs that gets taken out, more significant highs. Then price came back. Yeah, we could use this. We could also use this fair value gap, but that would, my stop loss then would be too big. So therefore, using this stop loss, this fair value gap right there. So then entry is right there. Stop, safe stop would be here. Target this high, because price now created this equal high. So that would be your first safe low-hanging fruit target. But you could also have a runner go for this high, and maybe higher at the interest areas we just looked at on the 5-minute. So this would also be a nice trade for the 2-minute. And let's see what the 1-minute gave us. Let's see. So you take this out. We now wait for a swing high to break. So here we took the sell side out. Price fails to go lower. Price did not really take out this high. Now price takes out a high closing above. Now this on the 1-minute hour range, from this low to this high, because this low, or maybe you could either consider this, but also use this. And then this would be the fair value gap, or this would be the fair value gap. So this is also a dealing range. So you want to look for prices in a discount. Why do you say it is a dip? Because it took out all these lows right here. Or maybe you want to use something like this. It's more accurate. Sell side taken, obviously buy side taken. price came back, and the 50 area, that's this low with this fair value gap. So that is also a nice entry for the 1 minute. After seeing this, you could place at this low maybe the limit order. You could use this low for 2 or otherwise this for 5 pips stop loss, which is still, and then you could aim for these equal highs right there. And there you go, where this high and maybe further. Anyway, there was a nice entry there during the London session. So going back to the 15, because we now explored the London session, which took out these relative equal highs and respecting this order block. And then what we see, lunch is retracing after we traded higher. So then what we could do is see how price is reacting, because at this moment, just before New York starts, we have this dealing range that I've marked out right here, right? So we have this low to that high is now created. So price came back. It didn't make any sense for price to trade back to the 50, because at the 50 level there is already this accumulation. All right. So we've already worked in this area. Price traded higher. So then it's the question: how deep can price go? Well, we have this fair value gap resting right here. This fair value gap on the 15 is resting here, and if we go look to the left, then there are 2 fair value gaps resting right here. We have this fair value gap, which has been traded to until this point. So that makes this a balanced price range, and then of course we have this fair value gap resting right here, which has been traded through and through, but it can also act as an inversion fair value gap in the future, and which is also in alignment with this 25%. So if we remove this one and we make this a solid line, for example, maybe do a dash line. Yeah, good. And this is also an inversion. Let's make it green. So what we now have, if we look closer and zoom in, price traded away with speed here on the 25% level. After it, when it left, it took out this high and was respecting a bearish PD array on the left. The important part is those highs that get taken out. Then price reverses, but also leaving relatively equal highs behind. Price trades back to the 25% level. During lunch, price tapped into the upper half of the upper portion of this fair value gap. Then when London opens, it takes out lunch low, because that's what it is. This is the low of lunch. So that got taken out, and look where it closes, way above the inversion fair value gap, way above the bullish fair value gap. Then price came back down once more again. So we have seen this, right? So this can now go away, and I'm just curious if we measure this wick. Exactly. Look where price is closing and respecting the 50% area of this big wick that took out lunch low. That is algorithmic, and it's also closing in very close proximity of the 25% level. That's a sign price does not want to go lower. So next what we see is this big bullish candle taking out all these highs, taking out the body, closing way above the body, and creating equally with this sitting right there. So this right here, this signature, is also a small consolidation, and this candle are breaking out of that consolidation. Then price trades higher, creating equal highs, trades lower, respecting this price also closing strongly above the midnight opening price. Price is now respecting the midnight opening price, and price shoots away, creating a fair value gap. When doing what? Taking out sell side right here, and taking out buy side resting right there. How do we take out the buy side? With speed. Did we leave a fair value gap? We did leave a fair value gap. Price comes lower, trades back into the old high, into this fair value gap resting right there. And look what price is doing, respecting the consequent encroachment, and price takes off once more to tap into this higher time frame PD array, respecting the weekly opening price, weekly opening level. So that's what price did, and then it just dies off and the weekend started. So let's see, maybe in this area, let's highlight this area to see if there's a trade resting in here, but there's definitely a trade in London close to trade, also take a trade, or maybe this is also dealing range, this low, this high. So let's see in the 5 minutes what we got here. So in the 5 minutes we see this consolidation, price taking out the low, nice signatures forming, no high has been broken yet here. So this is a swing high that needs to be broken on the 5 minute. So this is the, let's say, 15-minute low. And this is the 15-minute high. And this is a 5-minute high. So, all right. Price takes out this high with speed, with conviction. Also already an established bullish order flow. And this has already been traded into, and this is the only fair value gap that it has created, resting right there. This is the fair value gap. Right there. So what you could have done then, if you see this, I don't like fair value gaps that are that far in premium when bullish. So because this becomes the dealing range. Let me remove the high time from dealing range. This is the dealing range now. And I like to go, and I like the price to get back to a discount. So I'd rather see a discount fair value gap, but we didn't have one in this case. So that would mean if you follow the 2022 model, you go long here and put your stop loss below the swing low. You can then target 1-to-1 or just a fixed 1-to-2. I don't like fixed, but anyways, it would be a winner either way. But I'd rather would use in this case the dealing range, let's say dealing range model, which is Kelvin's model, and because this here is the breaker, right? The last upclose candles. So price trades into it, is respecting it. Price came up, came down, respecting it. So basically, when price touches this area right here, you can go long. Guys also still created these equal highs. There's still buy side liquidity resting above there. So using a breaker, you could this just below maybe the 75 level, targeting this over liquidity, and this would be very nice 1-to-2. So this is another model that I am practicing and implementing, because it's a dealing range from this low to that high, come back to the equilibrium, to the 50% level, which is in perfectly alignment with this breaker. So that's a nice trade there using this model. Then on the 5 minutes, it happens again, right? We have the same situation we have another push higher with this fair value gap. And I think this is the 15-minute fair value gap. So I would then use that fair value gap for you can do two things. You can extend this one like so, and as you can see, price is respecting the 50% level, and just above it there's this fair value gap price, and also there's this swing low. Price takes it out, comes back with speed, trades back with speed. This is the leg that takes out this low. So ideally, what you want to see is that this fair value gap becomes an inversion fair value gap. Price is respecting it, respecting it, respecting it. Then this candle trades above this bearish candle, which then becomes a change in the state of delivery. So this is a candle you could go long from. Stop loss below the fair value gap, or this low, or just below the consequent encroachment, or whatever you like. And target, that's if we go long here, it would be my first target, and my second target would, I guess, something below this, or maybe these highs. Anyways, that also would also be a nice trade. So that's the 5 minute. So let's dive into the 1 minute. See what we have here. So price takeout is high, and then what we need is speed. Well, I think this high, this leg, this is where the speed begins, is this leg, and there's this fair value gap inside this leg. Or maybe, yeah, no, I'm saying it wrong. No, I'm sorry. This is liquidity, no, wrong tool. Liquidity taken. So we have this low creating that high, with this high being validated. Here is displacement right there. So here price takes it out. So you put a long tool. Once this is created this candle, which strong, then would enter here. Stop loss right there. Target in this case, I would take an easy target like there. So that's a very nice trade, and would have taken out partials along the way. Oops. All right. So that's one trade, of course. In case you missed it, price goes back, respecting, you see this, or maybe it's too risky or whatever. Price trades back into the fair value gap, and price trades higher again, which is what, again, a new 1 minute dealing range, like so. Price trades higher, 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 until it reverses, which it does here. This here is the 50% area. On this leg, we have a fair value gap resting right there. Price does trade back into it with a pip. So in case you would have done something like this, you would have attacked. This is, you could use a stop loss here, or even a bigger one there. Target, if you enter here, could be here for nice 1 to 6, and obviously otherwise it would be here, or maybe here for minus 1 to 2, or even higher if you want the rest of the day. No, well, with targets that are on the left. So this would be another trade, because price is very nice, bullish. Then price takes out this high right here. So this is an intermediate term high, therefore expecting a deeper retracement. Also, what we now again have is this new dealing range from this low to this high right there. And of course, you can also measure this low to this high. It's also a possibility. Price came to the 50% level of the larger dealing range, and price traded below, way below the 50% of this nested dealing range. So where did it trade into? Into this area of consolidation, because there is a fair value gap resting right here. So let's see how it reacts to it. Very nicely, it is respecting the consequent encroachment, while before it was already almost trading and closing it. But there's also this fair value gap, this portion, so this makes it a little bit stronger, which therefore is a balanced price range. And there's also still this one right here. And look how many PD arrays are overlapping, and look how price is respecting it one way or the other. Also looking at all those sell side liquidity has now been taken with force, then price pays back strongly. This is a swing high with a fair value gap. Yes, there is a fair value gap right here, and a fair value gap right there. So if you put a position here, you would have been failed. Too bad. And this is of course a new dealing range resting right there. You should take out this high and this high. And price is now creating equal highs. Price goes back to where? I'm not sure. This bullish fair value gap. Also price very strong, respecting a premium fair value gap, and then price takes off again. But also look at this right here, because this is now balanced. This is all balanced. So price is respecting this balanced area, this consolidation. And then price takes off again. Yeah, so I think there were multiple entries to go long during London or New York, I'm sorry. Because also what I see is consolidation, manipulation, distribution. Then price trades lower, retracement. Came back in this area, and then finds its way up again. And finally in London close, it makes its retracements to make the close of the week. So this was my review again. I hope you enjoyed it, and see you next time.